All right, welcome back to the Deep Dive. We're the show where we take your sources, cut through all the noise, and try to hand you the sharpest insights. Today, we're kind of building a financial bridge, looking towards the future, and tackling a topic that, well, many of us know we should understand better, but it often feels like trying to see through a really dense fog. Life insurance. You've sent us a ton of great material, and our mission, like always, is to shine a light on those critical choices, specifically the big two, term versus whole life.
Indeed. And think of it like choosing the right blueprint for that bridge you mentioned. It's not just about, defining the terms. It's really about empowering you, the listener, to understand the fundamental differences, maybe some of the hidden trade-offs, and ultimately figure out which design best fits the unique landscape of your life and your loved one financial security. We want you to feel confident making that decision.
Okay, yeah, let's unpack this then. We all kind of get that life insurance is a safety net, right? A payout if the unthinkable happens. But what's the fundamental purpose it served? I mean, beyond just getting a lump sum, why do people actually invest in it? What problem is it truly trying to solve?
Well, at its core, life insurance provides a tax-free lump sum payment. That's the death benefit to your chosen beneficiaries if you pass away. And you mentioned tax-free, which is a really crucial advantage. Under current tax laws, generally, this payout goes to your beneficiaries free of income tax. That means the full amount you plan for is what they actually get. It's not diminished by taxes, which is honestly an often underappreciated benefit for families going through a tough time. This money, it's designed to protect their financial security. It helps replace your income, maybe pay off a mortgage or other debts, cover living expenses, fund the kids' education, or even just handle those immediate final expenses like funerals. So essentially, it helps your family maintain their quality of life and meet financial obligations even when you're not there anymore.
Right, so it's about providing stability when things are unstable. But let's be practical here. Who doesn't need life insurance? Or maybe, where do people often make the mistake of overinsuring? Because, not everyone needs $1 million policy, surely.
That's a great question. And it gets right to the heart of avoiding unnecessary expense. Not everyone needs it, certainly not to the same degree. If nobody depends on you financially, let's say, you're young, single, no significant debt, and you've got enough savings put aside for final expense as well, you might not need a large policy at all. The mistake of overinsuring, it often comes from, I think, a fear-driven approach rather than a really clear needs-based one. However, even for those young, healthy individuals, they might still consider a smaller policy, maybe just to cover final expenses or, and this is critical, to lock in insurability.
Lock in insurability. Okay, can you expand on that a bit? Because that sounds like a smart move, like being proactive.
Absolutely. Life insurance is definitely cheapest when you're young and healthy. It just is. So if you buy a policy at, say, 25, you lock in your health rating and the premium for that age. But if you wait until you're 45, and maybe you've developed a chronic condition, like diabetes or heart issues, getting coverage suddenly becomes way more expensive, sometimes even impossible. So getting a small policy early on means you secure the ability to get insurance, often at a much better rate, before life throws those health curveballs your way. Sadly, though, statistics do show a pretty significant coverage gap in many countries. Just too many families are either uninsured or underinsured, leaving them incredibly vulnerable financially. And this really underscores why revisiting your needs as life changes is just so vital.
That's a really good point. Our sources definitely highlight that life insurance isn't a set it and forget it kind of thing. It's more like a living document, something that needs to evolve with you. Things like getting married, having a child, buying a home. These aren't just personal milestones. They're financial triggers, right? Signals to reassess that bridge and make sure it's still strong enough for your family's journey ahead. Okay, here's where it gets really interesting, I think, and where a lot of people hit that fork in the road. Once you figured out, okay, I need coverage, you face the fundamental choice. Term life or whole life. It feels a bit like choosing between, I don't know, a super efficient practical sedan and maybe a big, reliable SUV that's built for the long haul. They both offer protection, but their mechanics and philosophies are just fundamentally different. So let's start with term life. What's the deal there?
Right. Term life insurance, well, the name says it all, really. It's coverage for a specific period, a term. This could be typically 10, 20, or maybe 30 years. If you pass away during that term, your beneficiaries get the death benefit. Simple as that. If you outlive the term, well, the coverage just ends. Now, many policies do offer options later, maybe to convert to permanent insurance or to renew, but the core idea is temporary focused protection for a set time.
So it's about simplicity, affordability, but for a defined window. Our source has consistently flagged term as the cheapest way to get a really substantial amount of coverage. Why
Yeah,
is that? What actually makes it so cost-effective compared to other types?
precisely. It's basically a streamlined product. It focuses purely on the risk of mortality during that term, without the extra investment components you find in permanent policies. Premiums typically stay level for the whole term you choose, which is great for budgeting, gives you that predictability. And if, by the end of the term, your kids are grown, maybe the mortgage is paid off, you might just let the coverage lapse because that big financial need isn't there anymore. This directness, this kind of lack of additional features, that's why it's usually the most affordable way to get income replacement coverage, and why it's often recommended for most people's main needs. So for you, the key takeaway for term life: temporary, cost-effective coverage, and no cash value component.
Okay, so that's our efficient sedan for those specific journeys, those specific years. But what if your financial responsibilities feel, well, less temporary? What if you need a safety net that you know will absolutely be there no matter what, a net that never expires? That brings us to whole life insurance. It operates on a totally different philosophy, right? Our sources describe it as permanent insurance.
That's exactly. Whole life is the most common type of permanent life insurance. This means it's designed to last your entire life, provided, of course, you keep paying the premiums. It guarantees a death benefit whenever you pass away, whether that's at 75 or, 105 plus. But the really distinctive feature, the thing that sets it apart, is its cash value component. Now, this isn't just a simple savings account tacked on. It's more like a financial asset that grows over time, often at a guaranteed minimum rate. And sometimes it can even earn dividends if it's what they call a participating policy, meaning you get to share in the insurance company's profits.
A cash value component that grows and can earn dividends. Okay, that sounds potentially powerful. But what can you actually do with that cash value? And maybe what are the less obvious implications or caveats people might overlook when they hear cash value?
Yeah, that's where the details really matter. You can borrow against the cash value. You could even surrender the policy entirely and take the cash value if you really needed to. So it does offer liquidity. However, and this is vital to remember, borrowing against your cash value isn't just free money. It's a loan. It accrues interest. And if that loan isn't repaid before you pass away, it will reduce the death benefit that your loved ones ultimately receive. So yes, it offers flexibility, but it's a tool you need to use with caution. Also, while whole life guarantees that payout and keeps premiums level for your entire life, it is significantly more expensive than term life for the same amount of coverage. We're often talking 5 to 10 times higher premiums, sometimes even more, compared to an equivalent term policy.
Wow, 5 to 10 times higher. That's huge. So for that significant extra premium, are people truly getting 5 to 10 times the value? Or are there more cost-effective ways to reach similar financial goals, maybe combining term with some separate independent investments?
That's a crucial insight that comes up a lot in our sources. While the guarantees of whole life, the lifetime coverage, the guaranteed cash value growth are certainly appealing, the internal rate of return on that cash value often doesn't keep pace with what you could potentially achieve by doing exactly what you said, taking the premium difference between whole life and term and just investing it yourself in a diversified portfolio. Now, this isn't saying whole life is inherently bad. It provides discipline. It's kind of forced savings mechanism, but it does highlight a significant opportunity cost. So for you, the bottom line on whole life, yes, it's lifelong coverage. Yes, it builds cash value, but it comes with a much, much higher cost. And that cost involves a trade-off in potential investment returns elsewhere.
Okay. So we've got our two blueprints laid out, the focused, efficient term and the comprehensive, permanent whole life. What does it look like when we really put them side by side? Let's try and highlight some of those key differences again, just so you can clearly see which bridge design might be the best fit for your family's specific needs.
Yeah, if we lay them out, the contrasts become really stark. First, coverage duration. Term is fixed. It's temporary, designed to cover specific years, usually when financial responsibility is highest. Whole life, on the other hand, is permanent. It's built to last your entire life, as long as you pay the premiums. Second, purpose. Term is primarily about income replacement and debt coverage for those temporary needs. Think raising kids, paying off the mortgage. Whole life leans more towards lifelong protection, maybe estate planning, or leaving a guaranteed cash legacy. It's often used when you want that certainty of a payout no matter when death occurs. And third, cost. This is a biggie. Term is much, much lower. It's the most affordable way to get a significant amount of coverage. Whole life is considerably more expensive for the same death benefit amount, though that premium is typically locked in for life.
Could you give us maybe an even more tangible example of that cost difference? Because saying 5 to 10 times higher is impactful, but seeing the actual dollars might really hit home for someone looking at their monthly budget.
Absolutely. Let's take a hypothetical healthy 30-year-old. For a $500,000 20-year term policy, they might pay somewhere around, say, $20 to $30 per month, give or take. Now, a whole life policy for that same $500,000 death benefit, that could easily cost $300 a month, maybe even more. That's a massive difference, right? And it makes term often the only realistic choice for families needing substantial coverage during their peak earning and responsibility years. Our sources consistently point to this cost factor as the main reason most families find term life more suitable for their primary income protection and debt coverage needs.
Yeah, that difference is stark. And the cash value, which we've touched on a few times now, that's obviously another major dividing line between these two, isn't it?
Indeed. Term life. No cash value. It's pure insurance against the risk of dying during the term. If you outlive it, there's no payout, no residual value. Whole life, conversely, builds that cash value over time, value that you could potentially access while you're still alive. It acts like that forced savings component we mentioned, growing usually at a guaranteed rate. But while it offers liquidity, it's also a big part of why it's so much more expensive. And it's why some financial advisors advocate for that buy term and invest the difference strategy, aiming for potentially greater long-term wealth accumulation outside the insurance policy itself.
Okay. And finally, the payout condition. That's kind of the ultimate moment of truth for any insurance policy, isn't it? When does it actually pay out?
Exactly. With term, it pays out only if death occurs during the specified term. Survive the term, the coverage expires, no benefit is paid. Whole life, on the other hand, is designed to pay out whenever death occurs, period. As long as the policy is enforced, the coverage doesn't expire. So it guarantees a benefit for your loved ones, regardless of your age at death.
Okay, so we've covered the what and the how they work. Now, let's get really practical, the how much question. Designing your financial bridge, you need to know its load capacity, right? How do you actually determine the right amount of life insurance for you and your family? How do you avoid just, pulling a number out of thin air?
Well, there's that common guideline you sometimes hear, get coverage equal to 10 to 15 times your annual income. But honestly, that's really just a very rough starting point. What's truly fascinating and important is that everyone's needs are profoundly unique. A much better, more precise approach is what's called the needs analysis method. This involves sitting down and thoughtfully calculating all the financial resources your family would genuinely need if you weren't around anymore.
Okay, walk us through that calculation. What are the key things listeners should be factoring in when they, sit down at the kitchen table and try to crunch these numbers? What gets added up?
Right. You'd essentially make a list, itemize your family's financial obligations and also their future goals. Start with the big debts. Paying off the mortgage is usually number one, plus any other significant loans, car loans, student loans maybe. Then think about big future expenses. Funding your children's college education is a common one. Next, you need to consider covering daily living expenses for your dependents. For how many years? Maybe until your youngest child is independent. Or maybe you want to set aside an emergency fund or even contribute to a retirement fund for your spouse's future security. And definitely don't forget the immediate costs. Funeral and final expenses can be surprisingly substantial. Then finally, you subtract any existing assets or insurance that could help meet these needs, things like savings, investments, maybe life insurance you already have through work.
That sounds really thorough. Could you give us maybe a concrete example, put
Yeah.
some numbers on that calculation for, say, a typical family scenario?
Certainly. Let's imagine a family with young kids and maybe a $300,000 mortgage balance. They might estimate $300,000 for the mortgage payoff, maybe $200,000 total for college funds for 2 kids. And then let's say they want to replace 10 years of the primary earner's $70,000 income for living expenses at $700,000. Add in perhaps $15,000 for final expenses. So the total need there comes out to $1,215,000. Now, if they already have $100,000 in savings and maybe a $50,000 policy through work, you'd subtract that $150,000. So the remaining need, the amount they should look for in a new policy, is around $1,065,000. It's a personalized sum, you see, not just a generic multiple of income. If this whole process seems a bit daunting, and it can be, there are plenty of online life insurance calculators. Or talking to a financial advisor can definitely help you land on a comfortable, realistic number. The absolute key, though, is to aim for sufficient coverage so your family wouldn't struggle financially. Some insurance is always, always better than none.
All right, we've really unpacked a lot today. We've navigated these different blueprints and calculations. So, bringing it all together, how do you, the listener, make that ultimate choice? Term, whole life, maybe even some kind of combination? What's the guiding principle at the end of the day?
Well, for most people, and this comes through strongly in the sources, term life insurance tends to be the foundational choice. Its affordability and its straightforward purpose just align really well with the period where you have those significant but ultimately temporary financial responsibilities.
Yeah.
Think about it. A 20 or 30-year term policy can very effectively cover those critical years until the kids are independent, the mortgage is gone, the biggest debts are paid off. It's the efficient bridge designed for that specific, albeit long, journey.
Okay, so term is the starting point for the majority. But when does that permanent, much higher cost structure of whole life genuinely make sense? I mean, beyond just being a nice to have, when does the added complexity, and especially that cost, truly justify the investment?
That's a critical question to ask. You should really consider a whole life, or maybe another type of permanent policy, if you have very specific circumstances. For instance, if you have a lifelong dependent, maybe a child with special needs who will require financial support well into adulthood, beyond your own lifespan. Or perhaps if you're looking at the cash value primarily as a forced savings vehicle, or maybe for complex estate planning or wealth transfer strategies. And, crucially, you've already maximized other, more traditional and often more tax-efficient retirement savings options, like your 401k or IRA. The big caveat, though, the one our sources really emphasize, is that you absolutely must be able to comfortably afford that much higher premium long-term, without it stopping you from saving adequately for other essential goals, like retirement itself, if you can't comfortably afford it. Then it's generally better to stick with term, make sure you have enough coverage there, and then perhaps invest the difference independently.
Right. So it's not always strictly an either decision then. Our sources definitely suggest that blending these two approaches, creating a mix, can often be the most strategic way to build that comprehensive financial bridge.
Absolutely. That's a very common and often effective strategy. You might call it layering. For example, someone might have a large, robust term policy to cover the big needs income replacement while kids are at home, the mortgage debt, because that's the period of highest financial risk. Then they might complement that with a smaller whole life policy, maybe just enough to cover final expenses or leave a small, guaranteed legacy, ensuring there's some payout no matter when death occurs, even after the term policy expires. Life insurance is incredibly customizable, really, and layering different types of policies can be a very efficient way to address different financial needs across different stages of your life. The most important thing, get covered while you're insurable. Don't wait until health issues pop up and make it super expensive or even impossible. And choose a plan or a combination of plans that truly meets your family's specific needs and fits realistically within your budget.
Wow. That was an incredibly insightful deep dive today. We've really navigated the sometimes confusing waters of life insurance, from the basic why right through to the distinct features of term and whole life, and even how to start thinking about how much you might need. Hopefully you, our listeners, are feeling much more confident now about designing that essential financial bridge for your loved one's future.
And maybe this raises an important question for you to reflect on. Given that significant coverage gap we talked about, the one affecting so many families, and knowing now about the wide range of customizable options available, what steps can you take, perhaps starting today, to assess or maybe adjust your own family's financial security plan? Really think about your current life stage, your future goals. It's a powerful conversation, honestly, and potentially one of the most important financial conversations you could have, both with yourself and with your loved ones.
That's a fantastic, truly thought-provoking idea to leave you all with. Thank you so much for joining us for another deep dive. We really hope you found it as valuable as we did putting it together. Until next time, keep digging for knowledge.